Hello friend, welcome to this video about the fair value, which is actually the first episode of a long series about financial evaluation. And just to have the right perspective, this video is not meant for you to become a financial analyst. It is just some kind of intro to evaluation. And to help you understand the market dynamics, we are going to start by delving into the concept of fair value. Then we'll discuss the relationship between the fair value and price action. And finally, we will study evaluation methods. One of the most influential economists, John Maynard Keynes, once said, "On the long run, we are all dead." Meaning that on the long term, the economy and by extension, financial markets are always rational and self-sufficient. However, on the short term, markets tend to generate noise and randomness. So the goal of this video is to try to understand what is truly driving the markets on the long term, which is basically fairness in pricing. Furthermore, fairness in pricing is one of the main hypotheses of the auction theory, but this principle can only be used to forecast long-term movements. Now, prior to delving into the fair value and trying to understand this concept, I guess it's more important to have an idea about the market efficiency hypothesis. The market efficiency is a state of equilibrium where the price of each asset is equal to its fair value. In other terms, each asset is neither overvalued or undervalued, but rather its price is just fair for both buyers and sellers. And when we talk about the fair value, it is simply equal to the cash flows that will be received by owning a certain asset. For instance, if a bond is going to pay you a coupon in 1 year of $100, then logically the fair value of this bond is equal to $100. However, by simply bringing future cash flows into the present, we are disregarding a lot of factors, whether it's inflation, the cost of opportunity, or even the risks associated to owning this asset. So to properly bring this future value into the present, we always calculate something called the net present value. To find the net present value of a future cash flow, we divide the amount of the cash flow by 1 plus the discount rate. The discount rate should factor a lot of attributes, depending on the nature of the asset we're talking about. But usually we want it to include 2 attributes, risks, and again, the cost of opportunity. When we talk about the cost of opportunity, it is simply the cost of making a decision. And I guess the best way to understand this concept is by reflecting on your own life. You have a limited resource, which is your time, and plenty of options. Now, you are using it to watch this video, but you can simply do something else, like scrolling on social media. So you compare the risk of both options. The risk associated to the first one is the time and money spent on your personal growth. So the risk is high since you choose a path that will take a lot of time and effort. However, the risk of scrolling on social media is only your time. Nonetheless, when we talk about returns, the first option can be definitely more rewarding than the second one, but only if you give it your all. In the context of financial markets, each time you enter the market, you're choosing between a lot of options. First of all, between 2 asset classes, and also between instruments within the same asset class. For instance, if you're willing to buy a bond or even a stock, you have multiple other companies that may have different yields and risks. And ultimately, you want to buy the stock that would have the most returns in the future with the least risk. But at the moment of making the decision, in the present, you don't know with exactitude which one is going to provide the most returns. However, you can have an idea about the risk associated to each one, and you need to factor that. After making the decision of which stock you are willing to buy, you also make indirectly the choice to sell your currency, whether it's dollar, euro, yen, to buy equity. So you make the choice between 2 asset classes. When we talk about risk, it's a vague concept since we have a lot of types of risks. For instance, the risk of inflation, or the value of money decreasing over time, or maybe the risk of liquidity, which is simply the lack of participants in a market leading to the inability to sell or buy an asset without paying a high premium. Since I don't want to make this video long and boring, if you think that the concept of risk is relevant for you, I will release an article explaining this concept in depth along with the different types of risks. So if we take the previous example of our bond, its fair value should be equal to $100 divided by 1 plus the discount rate. However, if this bond is going to provide multiple payments throughout its lifetime, you basically use the same logic, but this time, the risk must be carried for multiple years. So we divide the future value of cash flow by 1 plus the discount rate squared by the number of years until the payment. So in a nutshell, we can say that the fair value is simply the sum of the net present of cash flows. Let's say, for instance, that we have a bond with a face value of $1,000 and with 5% in coupons or yields in a context where the discount rate is equal to 3%. And the maturity of this bond is in 5 years. So over the next 5 years, we will receive coupons of $50 each year. Finally, at the maturity of this bond, we'll get back our initial payment of $1,000 plus coupons of $50. So if we apply the previous reasoning in this case, then we should divide each cash flow by 1 plus 3% squared the numbers of years until the payments, and the fair value of this bond should be equal to 1,091. And after finding the fair value of a certain asset, we kind of have an idea of the amount of money that will get paid in the future by owning this asset. And if you think about it rationally, if you're willing to engage the market, for instance, to buy this bond, it wouldn't make sense for you to buy it for a price that is higher than its fair value of 1,091, meaning that if the market is overvalued, you should stand still and wait for the price to reach the fair value before buying this asset. Thus, we can conclude that the market efficiency hypothesis makes sense somehow, or at least in theory, because for the market to be efficient, some conditions must be respected. For the sake of simplicity, we're only going to discuss 2 conditions. The first one is the participants are rational, and in the context of financial market, rationality manifests itself in 2 ways. The first way is regarding the way data and info are analyzed, and the second one is about the process of decision-making, meaning that all decisions must be the result of logic and reason. When we talk about rationality regarding the way we analyze data, it's mainly about perception, because to find the fair value, we need to factor a lot of data. But the way we perceive this information and analyze it can differ widely. And in this context, we're of course talking about economic indicators, whether it's GDP inflation or any other indicator. But if we talk, for instance, about price action, if we take the same sample of price, it will be analyzed differently regarding the strategy and the perception of the participant. This piece of price action, for instance, can be analyzed using trend lines, support and resistance, ICT concepts, or we can simply add a lot of other indicators. And the goal here is not to say that a certain way of doing things is better than another one, but to simply understand that participants are using different methodologies. As a result, they have different conclusions. Also, rationality manifests itself in the process of decisions making because you can have all the data analyzed perfectly, but still be the victim of some mental shortcuts that we call heuristics, leading to cognitive biases and cognitive dissonance. So at this stage, it's not even about having the right analysis, but rather about the ability to act on this analysis by being objective. Also, for the market to be efficient, all the participants need to have equal access to data. Because again, to be able to forecast the future cash flows of an instrument, we usually need to use a lot of info. And this information can be classified in a binary way. You have private information and public information. Public information is accessible to everyone since they're released through official channels, while private information is only known by insiders. As a result, I guess the right way to think about participants within the marketplace is by placing them within a spectrum. On the first extreme, you have perfectly informed participants having access to both private and public info. On the other side, you have participants having only access to public info. Simply us. And of course, outside of the spectrum, there are some participants who have access to the data who actually don't care about it at all. Those are typically people just acting based on emotions and mimicking others. And of course, when we talk about private data, it's illegal to use this info to make trading decisions. It's called insider trading. But it doesn't necessarily mean that perfectly informed participants will completely disregard this info while engaging in the market. Also, the only factor preventing them from sharing it with others is morality. That's why within the spectrum there are some participants who have access to public data, but also some private data depending on the network and their socioeconomic status. With that being said, it's so hard to defend the argument of the markets being efficient, and that's why John Maynard Keynes thinks that the market is always rational on the long term, but in the short term, they generate noise and random movements. Now that we have established that the fair value is the only principle driving the market on the long run, we will seek to study evaluation methods to know how to determine the fair value for each asset. We're going to start with forex, then we'll talk about bonds, and finally about stocks. The fair value of forex instruments doesn't only depend on the cash flows, but rather a combination of the level of supply, each currency, and cash flows that can provide. Well, first of all, currency isn't something that has value in of itself. Its real value is only based on trust, and the level of trust is determined by the attitude of the one that has control over it, the central banks. Because even if a currency can provide a high yield, if the central bank that is in charge of it doesn't control its supply, that will eventually lead to inflation and this yield being worth less. So concretely, when you go to the marketplace and trade forex pairs, you're always making a choice between two currencies. For instance, if we talk about euro to dollar, for this instrument, the base currency is euro and the quote currency is dollar. And when you choose to go long on this specific forex pair, you are choosing the base currency over the quote currency, meaning that you are buying euro and selling dollars. And in the opposite scenario, when you go short on your dollar, you are choosing dollar and selling in euros. When we try to forecast the fair value of this pair after a specific period, we always assume that the market never provides us free lunch. Concretely, you can't make money with an arbitrage approach. For instance, in the case of EU, whether you choose to own euro or dollar, the amount of money that you will have after 1 year is the same. Let's assume that euro has a rate of 2% and dollar has a rate of 5%, and the spot rate is equal to 1 today. So if you have $1 million and we choose to keep it in dollars, this amount of money will be worth 1 million plus 5% of 1 million. However, if we choose to convert it to euros, it will be worth 1 million euros plus 2% of 1 million euros. So no arbitrage simply means that after 1 year, $1,050,000 is equal to 1,020,000 euros. So in that case, the spot rate after 1 year should be equal to 1,020,000 divided by 1,050,000, which is equal to 0.971. The reasoning behind these calculations is that we have initially converted dollars to euros, and to convert euros back to dollars, we need to exchange them with the new spot rate. So in the absence of a behavior qualified as moral hazards on the part of the central bank, this spot rate for forex instruments is only driven by interest rates, and we will develop more on that in the video of game theory. Finally, I don't want you to go to the marketplace and use the reasoning behind the interest rate parity formula to try to predict the next spot rate. As I have mentioned in the beginning of this video, these ideas are just meant to help you develop the reasoning of a financial analyst. Once we study game theory and fixed income, you will have all the necessary tools to navigate the forex market with ease.